Hello, this is Nataraj Upadhyay. It is time for a special mutual fund report, which is detailed hybrid funds returns analysis. The promise is to do this at least once a month. So we are doing this as on August 16, 2024. So let's go ahead with the analysis. Now, before we proceed with the analysis, it is good to kind of review our understanding of various types of hybrid funds. There are 7 different hybrid funds as identified by Value Research. First one is hybrid aggressive. These funds are also called as equity oriented funds in other contexts. They primarily invest in equity 65 to 80%. The rest, which is can be 20 to 35%, will be in debt. Next type is balanced hybrid funds. Both in equity and debt are balanced in between 40 to 60%. Dynamic asset allocation is another type, which is also called balanced advantage funds. So balanced advantage funds are not balanced hybrid funds. Okay, they are dynamic asset allocation funds. Here what happens is asset allocation is dynamic, and between equity and debt, it can be from 0 to 100%. Multi-asset allocation is a fund where equity and debt and commodity funds. Commodity means here either gold or silver, and these three are involved with at least 10% on each asset class. So there can be various variations because of that. Conservative hybrid, also called debt-oriented funds, are primarily in debt, and typically 60 to 90% will be in debt, the rest in equity. Equity savings, risk of equity is balanced with the hedge of equity derivatives. Then there will be some debt instruments too. 65 to 100% will be in equity. So there is some variation here also. The last one is arbitrage funds. In arbitrage, what happens is there is an arbitrage strategy of buying the equity in cash and simultaneously selling in futures. That way, you protect your investment against volatility. Of course, that reduces your upmove advantage also. 65 to 100% will be in equity, rest will be in debt. This is where equity investment gives a debt level return. You know, so some equity returns that are available because of the annual dividend, etc., can be benefited here. But this arbitrage fund is the one that gives you debt level return in general. So there are 7 different funds, and the percentages marked here are notional because a particular fund may use a different percentage than what is guideline here. And in fact, when I noticed the definitions across various brokerage houses, the definitions varied in these percentages. Anyway, our purpose is not academic here, just to get a feel of what is a typical hybrid fund type. I hope this is clear for you. So with this, we are moving now to the performance summary of the hybrid funds. So entire hybrid mutual fund universe has 219 hybrid funds with a weekly return of 0.41, monthly return of 0.24, 3-month return of 6.17, 6 months return of 9.95, and 1-year return of 22.03%. Now there are 7 different subtypes here, and in each subtype, a return in each timeline, if it is better than the average, it is marked in green, and if it is lower than the average, it is marked in red. So by looking at a particular fund subtype, by looking at the color, you will understand whether this particular fund type did better than average or not. Now let us look at what are those 7 subtypes. Hybrid aggressive, 49 funds are there. Balanced hybrid, only 6 funds. Dynamic asset allocation, 38. Multi-asset allocation, 40. Conservative hybrid, 34. equity savings 24, hybrid arbitrage 28. Totally, it will come to 219. So on a weekly basis, these top four did well and the rest didn't do well compared to average. So similarly, you can look at it on a monthly basis. The aggressive one did not do well. It was below average, but otherwise it's pretty much above average. Now balanced hybrid was below average on a annual basis, right? Now the dynamic asset allocation was above average in all timelines. Okay. Then you may ask a question, why it came third in the rank. Now let us understand how the ranks are identified. The ranks are identified by giving performance rank on a weekly basis, monthly basis, 3 months basis, 6 months basis, and 1 year basis. Then these ranks are averaged, and based on that average, overall ranks are given. Okay. So dynamic asset allocation, though it has, as on today, above average returns, its past returns, if you notice, 1 month basis, it is 5th in position. Okay. 1 week basis, it is 4th in position, and 6 months, it is 4th in position. So as a result, it's moved to a 3rd position. So the order of these funds marked here is the overall return rankings of these funds. So the further discussion is given in this order of ranking, and on a monthly basis, these rankings may change a bit. However, you could say that the aggressiveness of the hybrid fund is highest in the top ranked and lower in the lower rank, except for some corrections based implications once in a while. So let us understand this more in detail. So we are going to the next screen, which is to discuss aggressive hybrid fund. Now the aggressive hybrid fund, we said, is more in equity and less in debt. So the highest annual return, if you notice here, is in the range of mid 50. JM aggressive hybrid fund has 53.54. Okay, for example, right, which is a bit subdued compared to 71 point something for the top 50 equity funds, right? So you get an idea. So hybrid funds have been a good, balancing against risk of equity correction. However, it is my observation that the equity portion of hybrid funds are not very well managed like the equity funds, because look at it. How many aggressive hybrid funds are there? 49. How many equity funds are there? 861. So there is far more competitiveness among the equity funds and far more diversity as to how to manage the equity. Whereas it is my observation that the equity portion of these hybrid funds are probably managed with a level of arrogance or apathy. As a result, when the equity portions correct in the market, the equity portion of hybrid funds also correct more than the equity funds. As a result, during the correction time, while the debt portion gives a good cushion against the equity correction by say up to 35%, the equity portions do correct worse than top equity funds, is my observation. However, if you are managing risk, the aggressive hybrid fund is a very good antidote against potential corrections in the equity funds. Now let us look at the top green ones, which are basically having above average returns in all timelines. Bank of India Mid and Small Cap Equity and Debt Fund has given you 47.59%. The data for monthly, for some reason, is missing. Axis Retirement Savings Fund Aggressive Plan 37.74 for the year. JM Aggressive Hybrid Fund 53.54. Mahindra Manulife Aggressive Hybrid Fund 37.81. EW's Aggressive Hybrid Fund 36.88. Union Children's Fund, new fund, only 6 months return 16.01. Kotak Equity Hybrid Fund 34.33 for the year. Invesco India Aggressive Hybrid Fund 39.11, Tata Retirement Savings Fund Moderate Plan 33.23, UTI Aggressive Hybrid Fund 34.04. See, you can see here that Tata Retirement Savings Fund Moderate Plan has come in here than the aggressive plan because of the equity corrections that are in the background. The one in orange are those with above average return except for one timeline. Let us consider some. Axis Equity Hybrid Fund has a subdued annual return. It has been doing slightly better in the recent times. Axis Children Gift Fund again low on annual return. DSP Equity and Bond Fund low on annual return. Baroda BNP Paribas Retirement Fund is a new fund. Since it has no data above 1 month, it is marked as orange. HSBC Aggressive Hybrid Fund did not do well in the last 1 month. Union Retirement Fund did not do well in the last 1 month. SBI Magnum Children's Benefit Fund Investment Plan also did not do well in the last 1 month. So that gives you the range of choices for your fresh investments in a hybrid fund. I like the most is GEM Aggressive Hybrid Fund because it is the annual leader and it is consistent in all timelines. Next, we are moving to balanced hybrid funds, right? So in balanced hybrid funds, there are only 6 balanced hybrid funds and their returns are way subdued compared to aggressive funds. Let us look at the annual return of aggressive funds are 32.32 on average, whereas the balanced hybrid funds are only 20.46%. Again, many people are happy with this. So the only one with green status is White Oak Capital Balanced Hybrid Fund, which is a reasonably new fund because 1 year data is not available. And other two are in orange, UTI Retirement Fund with 22.01%, 361 Balanced Hybrid Fund, again a new one, and 13.89 for the 6 months basis. So this is balanced hybrid funds. Next, we are going to dynamic asset allocation. Dynamic asset allocations is where the fund allocation is very dynamic. It can swing from 100% debt to 100% equity, right? So there can be so much volatility with respect to returns depending on the fund manager decisions. So let us look at the green ones here. Axis Retirement Savings Fund Dynamic Plan 40.29 for the year. NU Balanced Advantage Fund 33.69%. Nippon India Balanced Advantage Fund 26.90. Axis Balanced Advantage Fund 30.25. And the overall average is 26.41, which is better than balanced fund but below the aggressive funds. Right now, let us look at the newcomers here. Motilal Oswal Balanced Advantage Fund, which is in orange because annual return is subdued. Bandhan Balanced Advantage Fund, again annual and 3 months returns are subdued. White Oak Capital Balanced Advantage Fund, annual return subdued. Aditya Birla Sun Life Balanced Advantage Fund, annual return subdued. Baroda BNP Paribas Balanced Advantage Fund, 3 months return is subdued. So you will see the case for orange ones, except in one particular timeline, they are not doing well. The bottom ones are definitely not doing well in the last 1 month. HDFC Balanced Advantage Fund is a very good fund with 37.90, but got hit in the last 1 month basis. Quant Dynamic Asset Allocation Fund, 56.72% annual return, but not doing well in the last 1 month. So when the markets recover, this likely to pull back and come to the top in the green status. That's why my analysis always identifies the orange ones also. So you cannot completely ignore them. Now we are moving to multi-asset allocation. Multi-asset allocation on average is comparable to the earlier ones, dynamic allocation. So dynamic allocation and multi-asset allocation are quite comparable. Only thing is multi-asset allocation can do better when the commodities are on fire. Unfortunately, in the recent times, commodities are on a correction mode. Hence, multi-asset allocation may be bit subdued. Otherwise, it would have beaten the dynamic allocation. Now, the one in green are UTI multi-asset allocation, 41.26%, Aditya Birla Sun Life Financial Planning FOF, 34.03, Bandhan multi-asset allocation fund, it's a new fund, 13.86 for the 6-month basis. The one in oranges, Axis multi-asset allocation fund, subdued annual return, HSBC Managed Solutions India moderate, it is subdued for the last 6 months. And the bottom ones with negativity, but with the high annual returns are Aditya Birla Sun Life multi-index fund of fund is negative, but annual return is around 37.87. So this is the option of multi-asset allocations. Let's move on to next one. Hybrid, conservative hybrid funds give you an average 15.06 annual return for the current market conditions. The one in the green are SBI Magnum Children's Benefit Fund Savings Plan gave you 22.63, ICICI Prudential Regular Savings Plan 15.78, Axis Retirement Savings Plan Fund Conservative Plan 20.77, Kotak Debt Hybrid Fund 19.09, UTI Conservative Hybrid Fund 16.39. Then there are some in oranges. I want to discuss any specific orange one with high annual return. There are none, so let's not worry about it. So conservative hybrid funds giving you somewhere between 15 to 20%. Many people are happy with this kind of returns, and they feel safe with respect to the volatility of the equity. So if this is for you, consider it. Next is equity savings fund. The equity savings fund again is comparable to the conservative hybrid funds, 16.87% on average, and the highest one is in the range of 20 to 27%. The best annual return came from HSBC Equity Savings Fund, 27.56. The other one in green are Sundaram Equity Savings Fund, 20.09. UNESCO India Equity Savings Fund 22.47, Kotak Equity Savings Fund 21.20, Axis Equity Saver Fund 19.67, Edelweiss Equity Savings Fund 17.74. Now the one there are only three in orange. DSP Equity Savings Fund 16.08. It's a 16.68, which is subdued annual return. HDFC Equity Savings Fund 18.76, but subdued last 6 months return. Mirae Asset Equity Savings Fund 18.37 with subdued monthly return. So that is the equity savings returns for you. Let's move on to the arbitrage funds. You remember arbitrage funds invest on equity along with that, but the equity investments are managed in such a way they give a debt level return only. So therefore you'll see 8.2% return, which is comparable to debt funds, right? I personally wonder, why go for this? I am yet to appreciate why one would go for arbitrage funds. Maybe I should wait for a day where these arbitrage funds do far better than debt funds. Let us see. Maybe that is the reason when the interest rates start going up, probably arbitrage funds will do better than debt funds. But so that other than that period, I don't see why one should go for this, because anyway, these are taxed equal to equity returns. Now, here not much to discuss because the entire range is somewhere in between 8.46 to 8 below 8, and I am not getting into any detail here, but you can read it yourself. So that gives you the various hybrid fund types performance, both on average level and specific winners and worthy investment considerations. So I hope it helps you to tune your investments in terms of buy, hold, and sell. The standard disclaimers apply because this is in no way solicitation. So please go through the disclaimer. And this particular video, the video is already preceded by a blog. So if you want more details, go to my blog at natspermcorner.blogspot.com. All my future bulletins you can anticipate in one of my various social network platforms. So with this, I am coming to end of this bulletin. You will see another hybrid funds special report next month. I am thinking of another special report next week, maybe on debt funds, which will be done for the first time. Because personally, I'm not investing in debt funds because any interest in debt funds should lead you to hybrid fund as an individual. Because hybrid funds, as you see, give 7 different ways to invest based on your risk appetite. So when you have hybrid funds, probably you don't need debt funds. However, very large net worth people may consider debt funds, uh, as on certain special considerations, especially on managing the volatility against the equity portions. And also when the interest rates start going down, debt funds will give a better return because the face value of the debt instrument goes up while the interest it gives may reduce. There is a temporary hike. So there are people who are hoping to leverage this. So it is a good time, therefore, to look at debt funds as a baseline comparison uh, for potential interest rate reductions that are coming in the coming months. So I'm starting the special report on debt fund from next week and probably keep it for next few months, once a month, so that we can understand and appreciate the dynamics of interest rate reduction on the performance of these debt funds by various types. So this can be more of an academic exercise, and maybe there is a very less leverage for us to use these reports for our own investment strategy. Let us see, let us be open-minded and be on top of it while the debt funds will start getting excited with the interest rate news ahead. So with that, I'm coming to closure of this report. I will see you again next month. Thank you. Bye.